Good afternoon. My name is Dan Quigley. I am the Senior Vice President at Kirkpatrick Management Company. I'm in charge of the Association Division, which is what you all are a part of, as far as charge of the managers and the operation is as far as customer service reps and the accounting team, compliance team, different things like that. So I just want to start by just saying, you all have CAMs that you work with daily, if not daily, I mean weekly, if not weekly, daily, but I want to make sure that they are your first source of information. If you need anything, make sure you get a hold of them. If you cannot get a hold of them, call the office, and we can help you guys out right away. If there's an emergency, if there's something that you need an answer on right away, can't find anybody, what's going on, I'm going to give you my cell phone number. My cell phone number is 317-847-0016. Listen, you guys pay for my cell phone one way or another. It's your cell phone too. So if it's a small problem, if it's something you think you can handle yourself, that's great. But if you need a problem, we're here, and we have a 24-hour maintenance hotline that's on all the time, and there's always things like that going on. But if you need something, you can't get things done like you need it done, get a hold of me. I'd love to try and help. Kirkpatrick Management is celebrating its 51st year this year. It's a family-owned business. There are 4 Kirkpatricks working at the company today. As a matter of fact, one of our presenters, or our presenter today, is Paul Kirkpatrick, who does not work for the Kirkpatrick Management Company, but is part of the family that has owned and owned this company since 1973. Primarily, we will work in central Indiana. We do have a couple places outlying. We've got some stuff in Columbus. I guess that's still central Indiana a little bit, and one in Jeffersonville. But primarily, we have offices in Greenwood. We have a nice new office in Greenwood. If you're down there, please stop by and see it. We have the same office right now at 71st and Binford. Doors are open 9 to 5. You want to call in. You're always going to talk to somebody. Call in and say hi, or call in and ask a question if you don't know what's going on. We're here to help you. So one of the things, what we're going to do today is talk about insurance. And the insurance market, as board members, you know that and you see that has been changing a bunch. There is, there's some companies are getting in out of the market. Some companies are doing, just different things throughout the, as far as there's a lot of non-renewals. There's a lot of prices are going up. If you Google it on, I was watching this morning on Google or on YouTube, there's a lot of different videos and news clips of the Florida condos and the California condos. They're getting hit hard. We are getting hit, but it's not really, doesn't appear to be as hard as this. What I'm going to do is we've got Paul Kirkpatrick's going to talk a little bit today. He's going to talk about the market. He's going to talk about what you specifically need to do, how we can help, what you need to look out for. He'll talk a little bit about directors and officers insurance. And at the end, we'll have about 15 minutes where we can ask questions. I will ask you to put the questions. There's a Q&A box down there at the bottom, and or the chat box if you would like to do that. I think the chat box is turned off, so put it in the Q&A box. We will ask questions of Paul at the end. But right now, I'm going to go ahead and turn it over to Paul. And we're in the same room, so we're going to go back and forth on microphones here. But thank you all for attending. Come and go as you. We will actually have a copy of this. We'll email you a copy of this recording tomorrow, maybe Monday, by the time we get it cleaned up a little bit, and you can share it with the rest of your board members if you think it's worthwhile. But I appreciate you guys taking your lunch hour to come and sit with us. And I'm going to go ahead and turn this over to Paul. Thank you.
All right. Good afternoon, everybody. You got the first slide up? Okay. So like Dan said, well, let me introduce myself. I'm Paul Kirkpatrick with Realty Group Insurance. I'm an independent insurance broker. So we represent most insurance companies in the property casualty side. The exceptions would be like the State Farms and American Families that are captives. The advantage there is we see all the different companies that do different things with different prices. And so sometimes we have to move our clients around. And especially in the last few years, it's been playing whack-a-mole. I want to start with basically just going over the current market conditions, not specifically about community associations, because I think it is good information to know that just because the most common thing I hear is if it's the East Coast and the hurricanes and the fire, why are we paying for it? And what I'll show you is there's a lot more to that. Then we're going to talk about why specifically community associations of all other classes of business are becoming very difficult to insure and what we can do about it. And then, like you said, lastly, we'll talk about the D&O, especially for you guys in HOAs. It's very important because we'll get to that. But let's start with the big picture here in the insurance industry. Really, for the last several years, the hail, especially in the property market and weather-related events, the insurance companies are for-profit companies, and they publish their loss ratios. They make money one of two ways. They charge more premium than they pay out, and then they have investment risk, where they take all the money and invest it. Well, interest rates have been super low for a long time. And in the last few years, and we'll go through some more slides here, the amount that they've paid out in the last 5 years has jumped astronomically. This first one just shows a picture of the hail, and there's two more of these real quick. So it is very much a Midwest thing, and they call these things convective storms, is how they track it actuarially. And you can see the wind, and we're kind of right in the wind belt, the I-70 corridor, from Colorado, through Columbus. Hail is the #1 cause of loss. This next slide here, it shows, this is for 2022, and you can see that severe convective storms is the #1 loss. So that has kind of sent all the carriers, they basically have hunkered down and made some very aggressive changes in their policies. Here's another example. If you look up at the top, you can see the most recent years. Last year, we set a record with $28 billion loss events. You can see that in some of the other years right there, all within the last 5 to 6 years, we're kind of setting records on huge losses. That's what's driving this. All right, next slide there. This one here shows over time how much this has changed. You can see there in the 80s the number of events and the total cost, and as you scroll down, you can see the last 10 years, the last 5 years, and then last year. And so it is truly going up exponentially. And they do publish their loss ratios, and they are currently losing money. So this is another, I thought, a good slide where it kind of breaks it down into what the cause of losses are. So it's not hurricanes is definitely the biggest one over all these years, but the #2 one is the convective storms, the hail and the wind losses that we have here in the Midwest. The next thing that is truly driving this large change in insurance really started around COVID, where we had a spike in building materials, but there is still a shortage of homes nationwide, and the cost of construction altogether, go try to buy a new home right now. We were just at a Pulte community, a ranch with no bells and whistles, 1,800 square feet. They're starting at $215 a square foot before any upgrades. So that slide here, you can see, when they track inflation, they say it's this over so many years, but when you get it down into nitty gritty, the cost of actual material was up 34% there, and labor is up 27%. So that's another thing that is driving these rate increases. I will mention, moving on to liability policies. You got property policies, and you got liability. So they've been losing pretty heavily on property. One of the newer trends is this thing called nuclear verdicts, and I kind of describe it here of what it is, but it's a claim lawsuit judgment that is over $10 million. They're up, it's drastic. It depends on the specific industry, but like in trucking, it's up over 300%. The biggest one that really sent shockwaves through the community association world was the Champaign Towers collapse. That settled for $1 billion. The total insurance of all the policies combined on the Champaign Towers only amounted to 50 million in coverage, and they were paying around, I believe, 100,000 a year. So essentially, what it's called social inflation, and they believe that society hates corporations and are now just awarding what used to be a settlement for a slip and fall for 25,000 is now 150,000. So that's what's driving the liability side. The next one, there, that's some of the facts about nuclear thing. The next one, this is just an article from Reuters News. It was dated January 1st of 24. So insurance companies, they can insure, depending on their size, up to a certain limit regulated by the state. And then after a certain property limit, they buy reinsurance. Currently, reinsurance is at the highest it's ever been in recorded history. And they do these treaties every quarter or so. And basically, this article says basically went up 50% January of 24. So what that means is your smaller companies like Indiana Farmers is a local company. They're a very small company. They got to go buy reinsurance on everything over $7 million. Well, then they have this stuff with the Department of Insurance that they can only charge, they file their rates and they can only charge X amount above what they filed for the rates. Well, the cost of the reinsurance then takes them out of where they could make any possible profit, and they basically say we're out. So that has driven, supply demand of the carriers in the market. A lot of the smaller carriers can't compete with some of these very large condo associations. I know Kirkpatrick, and I have several communities that are 50-60 million dollars, and there's only a handful of companies on earth that can actually afford to do that without reinsurance. All right, next slide. I would say, yeah, so where we're at right now, the carriers, the result of all this, and this isn't just community associations, this isn't homeowners, this isn't auto. The cost of a fender bender used to be $500, $1,500. It's now $10,000. We replaced a car windshield the other day. It was $3,000 and needed a software update. So everything is getting more complex, more expensive. So in the last 2 years, most of the carriers, home and auto, commercial, they've hunkered down and said, we really don't want any new business. We're either going to get off the stuff we know is unprofitable, or we're just going to take as large of rate increases as we can, which is regulated by the Department of Insurance. So a lot of the companies that say we're just out, they're sitting waiting for the departments throughout the country to allow them to raise what rates they can charge to where they think they're actuarially going to make some money or break even. So that's kind of what's happening in the market generally. Then if we focus down more on the next topic of why are associations becoming so difficult.
Can we touch a little bit on this? Talking about how the Google Earth view, the street view, the grills on the balconies. Can you talk a little bit about you've had some people been canceled for that, right?
Absolutely. Yeah. So now when we go to a carrier, we submit our applications and the loss history. They're using maps from the sky for satellite to look at roofs, trees. They'll use street view. They will, if they see any grills on the balcony, even if it was there for one day, they're looking for any excuse to say no. So it could be the perfect community with no losses and everything, and they see grills on balconies, they're just out. And I know that's a touchy subject because a lot of people like to grill, but technically against the state fire code, anything within 10 feet of a combustible surface is a violation of the fire code. So that's a real touchy one. And they have data to back up. It says, these grills do cause fires and,
Yeah.
and claims.
But it's something I think that if the homeowners association and the boards, can keep up with their covenants and with the violations and see these people do stuff like that. But this is even more than just the covenants. This is state law in Indiana. So it's something, and the insurance companies aren't messing around. They're coming after you. And if they're looking for any reason not to do this, not in a bad way, but there's a lot of CYA out there.
Absolutely. All right. So, I guess it's the number one thing right now, especially for the large condo associations, especially the ones built in the 80s and 90s. The industry is kind of said if it's frame construction and it's over 25 years, we don't want you, period. And you say, well, that's kind of drastic. I mean, that's a huge change. Why are you doing that? And what they're finding is, an apartment used to be harder to insure than a condo because condo had pride of ownership. It was considered a better risk. But as an apartment turns over, the landlord can go through and update electrical, plumbing, and such. The problem they're having now with older communities is the association has no means of updating the electrical and the plumbing. And a lot of the carriers now they want pictures of circuit breaker boxes. They want pictures of plumbing because there's a polybutylene that seems to fail. A lot of these things that happened in the 80s and 90s. So basically that's just, again, limited the number of companies that even exist to get an insurance quote from. So I think we've talked about how terrible everything is and how difficult it is to insure. Most of the boards I work with, they say, all right, Paul, what do we do? We're on that slide yet. What should you be doing? I think it's basically a time where you have to relook at what happened in the past is probably over, and a $5,000 flat per occurrence deductible is going to be extinct. So looking at wind hail deductibles, larger per occurrence, 25, 50,000, is one way to mitigate that. Another, if the community is financially capable, is to start small reserves for the small little water claims instead of turning every little thing that happens in. Next, I know Kirkpatrick strongly recommends every association do a reserve study, and basically I think everyone's been budgeting 15-20% increase, and we're having 40-50% increases. And if some of these communities that have to go to the non-standard market, it's 100 to 300% rate increases. And I know that most of the communities aren't financially prepared. So I would say definitely over budget and plan for the worst. Specific things you can do, though, is look at, for example, the governing documents. If you're in a condo association and you're responsible for all the interior, that is driving the total building value, which then drives the total insurance costs. If some associations, more newer ones, they basically only insure, the bare walls outward. That lowers the total cost. So that's one way to mitigate that. Another thing we've been talking, especially with the HOA attorneys, is if you make it easier for the board to pass a special assessment when it's specifically regarding an insurance loss. And when we talk about wind hail deductibles here in a second, I'll show an example of how that'll work. And then we touched on the grills. Follow the rules. They're going to send out inspectors. They're going to look for stuff. And lastly on that slide is like, it's time to kind of reset expectations of what things cost. I know it's hard to raise the monthly fees, but I don't see this getting better anytime soon. So I was talking about a wind hail deductible. This is one thing I find that a lot of associations boards misunderstand. They think whether it's 1%, 2%, or 5%, they think it's a percentage of the loss. And that's incorrect. It's a percentage of whatever building was damaged. So in this example, I have a $20 million community, every building's hit with a 2% wind hail, that is a $400,000 deductible. And so that is a big change from what we've had in the past, where just a flat per occurrence deductible. And so then my board say, Paul, we can't do that. We don't have that in our reserves. What are we going to do? And when I was talking about the special assessment, I got on this next slide here. I took this as an example of one I gave to one of my associations the other day. And basically this is the scenario. Their total 60 million at 2%, that's 1.2 million. It happens to have 320 units. That comes out to a special assessment for each owner for the deductible of $3,750. One of the things that we really try to, I know that the CAMs do this, but inform your unit owners to make sure their HO6 has an endorsement for special assessment. The HO6 is a unit owner policy. When you add that, you can add that in increments of $5,000, $10,000, $15,000 for special assessment. What that means is if the association assesses you for a covered cause of loss, fire, hail, wind, you turn that into your HO6 policy and they will pay that special assessment. So that's one way of getting around these massive $1 million deductibles. You said you want to skip this for now? Okay.
This is a calculation that Paul has that might make sense to some actuaries out there, but the rest I can't figure it out. But that's what we have him for. But yeah, he knows he's been able to do the property value by percentages. And it's an interesting thing, and we'll try and send it to everybody tomorrow. But it's a crazy little thing he's got. Go to the next one.
Okay. Let's talk about directors and officers. I would say this is one coverage is one of the most important coverages you can have, and probably one of the most ignored, other than the fact they look at their policy and say, I got $1 million, check the box, and they move on. Directors and officers is sold in one of two ways. It can be sold attached as an endorsement to your business owner's policy or your commercial package policy. So it's attached to the policy and it's endorsed on. And then you can have a standalone policy. So I want to talk about a couple of the differences. The standalone policy, well, the endorsed policies are designed for every D&O for every type of commercial risk out there. They're not specifically designed for community associations. So CAI, there are about 4 different programs, one with Chubb, Travelers, CNA, and Cincinnati, that have specifically designed directors and officers policies designed for community association. And the devil's really in the details. This slide here is basically some examples of directors and officers claims. But the one thing I want to stress the most, the standalone policies are much broader in the definition of who's an insured, so past board members, spouses. It has coverage for non-monetary demands. That's probably the biggest one we see. I believe it's 70% of directors and officers claims are for non-monetary demands. An example would be, take the grill off your balcony, and they say no, and then they sue. And that's not over a monetary thing at all. It could be about trees. It could be about speed bumps, voter elections. Most of the very large claims are non-monetary. And the terrible thing is most of the directors and officers attached to your package or BOP exclude defense for non-monetary claims. So that's one huge reason we push that really hard. The second is the endorsed D&O or the package D&O. Defense is inside the limits, where a standalone policy has unlimited defense and $1 million in indemnity. So defense outside the limits. It covers full prior acts. If we go to the next slide, there's kind of a, these are some examples of some claims, yes. But basically, Oh, the other, when we're talking about right now, these very large property policies, one of the huge advantage of having a separate D&O is, let's say you have a minor claim, a director's officer's claim for $10,000. If you turn that into your property policy and then they raise your rates 20% and you're already paying $150,000, you just got a $30,000 increase. A standalone directors and officers policy costs on average about $1,000 a year. You could turn in a claim and have a 100,000% increase, and you're still way out ahead by not having that attached to your standard your BOP policy. So I mean, there's a lot of reasons why you want to have that separate. This next slide here is
Real quick on the D&O, we do want to make sure that we have all of our associations should all have a directors and officers insurance. If you on here do not know if you've got it, or you want to make sure that it's up to date, you know, a lot of times they might just, if it's an HOA, a smaller HOA, it might just be part of the general policy. We do push the D&O just because of its ability to, it just got some more protection, and it's for the cost. It's not even the cost of one mowing half the time for these neighborhoods. So it's really, you guys don't get paid to be on the board. You need to be able to just protect yourselves, and I think that's a big deal. One question I had, Paul, I can't remember this one. If a board gets recommendation from an attorney and does not follow that recommendation, or a professional of any kind, is that negate the D&O coverage? Do you know?
It wouldn't. It would still trigger the duty to defend. So they made a wrongful decision.
Okay.
And it would still defend them.
Okay. All right. Thank you. So all the people that have told that to, I'm sorry, I was wrong. All right, we'll move on. I should listen to Paul more.
Well, it doesn't mean they'll come out in the end.
No, I get
it. It just means that it still has the duty to defend.
Still has the duty to defend. Okay, good. I do have a question on there. Let me see if there's what we should do before we move on. No, I'll try. Okay, I'll try and be clear. We can't do both of them. I can't do both Paul and I at the same time. We're too close. So I'll talk a little louder. Sorry about that.
Oh, this I was just say that last slide is a great example. It's a marketing piece that Travelers uses, but these are all very specific types of claims, like breach of contract, noise violation exclusions. The directors and officers is a very, very specific policy with many exclusions, and they put this piece together because their policy actually covers all these things, where your standard BOP endorsement, what's called an ISO form, excludes all these things. And like I said, 70% of the claims are for non-monetary. So we can't push this enough. The difference for a directors and officers policy that's attached to a standard BOP or package, I would say averages around $500 a year. To have a standalone policy, it's around I would say $900 to $1,200. Okay. That's pretty much it. We skipped through a few things under underwriting, but you want to open up with questions, or?
Yeah. Okay, if anybody has any questions that they want to go ahead and type into that thing, I'm going to ask a couple different questions of Paul to get us started that we've had through the our CAMs have been asking questions through there. Who are the companies that have left the market in the last couple of years as far as the condo market? You've had a couple that they just completely left.
Yes, so Arrowhead, Leo, Grange. Nationwide has basically said anything over 20 million, they non-renewed. I would say Nationwide was probably one of the largest here locally, and has probably sent the most people into the secondary market. And then Middle Oak has come and gone. They're now back. under new paper, but it's much more expensive than it was before. And then you've had a lot of companies that they're still technically, like Travelers, for example, they could insure anything in the past, and they were one of the most competitive. They will no longer take anything over 25 years of age and more than 14 buildings. So they're still there. Liberty Mutual, they have a proximity of buildings issue. They want everything to be sprinklered. We don't have many associations around here that are sprinklered. Yeah, I could go down a list. I would say the ones that have left, the big ones was Nationwide. That made a huge, in Grange, that was a huge change. But there aren't many other places to go.
Okay. Keith has a question that you just touched on, and I was going to ask you the same thing. Can you explain what secondary insurance or secondary market means?
Sure.
And when that becomes something they need to look at?
Yeah. You'll hear the terms admitted or non-admitted, excess, surplus. So the carriers you're all familiar with that we've just been talking about, Travelers, Nationwide, Philadelphia, they're all admitted companies. That means the state of Indiana will stand behind them if they go insolvent. The non-admitted market, or the excess market, non-standard market, is generally carriers you've never heard of: Genstar, Admiral, Seneca. They're basically Lloyd's of London syndicates. And if you end up having to go to that market, it is, I'd say at minimum 100 to 200% more expensive. The deductibles, you're probably starting at 50,000 minimum, and they're usually putting at least a 3 to 5% wind hail deductible. And if they go insolvent, there's nothing you can do about it.
And so really that you pull that out when you just can't get any other insurance, and that's when you go to that market.
It's the avenue of last resort. So, and then when we do that, we then go to specialty brokers that don't work with the public. They only work with agents that then work with all those Lloyd syndicates, and then we put those people against each other to find the best of the non-standard.
Okay. One of the questions we get quite often is, okay, my insurance is up, or we're up in 3 months. Can we start looking for insurance now? And it seems to be that we really don't get any numbers back from not from you, but from anybody for 30 to 45 days. Is that where does that come from?
Right now, I would say the entire market is pushed to the edge, and everything is last minute. I mean, it doesn't matter what carrier. Everyone is just. I mean, it used to be 45 days. We'd want a submission, and then we'd have it within 2 weeks. Now we submit it 45 days out, and we're hoping to have it that week. It's just an unfortunate part, and I've found that throughout. Can you get it early? It's possible, but it's rare.
A lot of times they don't even pay attention to it.
No, they're all working in order of the effective date that they have on their list.
Okay. So Susan has a question. I'm gonna try and read this louder. Our HOA covenants require all-in coverage, and we are told that our current carrier is the only company that will provide such coverage. We are an 82 residence community with some residents standalone, about half share a wall with another residence. Could you comment on something like that? Is there only a limited amount of people that provide all-in coverage?
I've never seen a company say we won't insure because of all-in or walls out. Okay. That's not. I've not ever seen that as a factor. What does change is what building value we use for the replacement cost.
Okay.
So, with a few exceptions, we had that thing with Leo earlier this year where they specifically said they had an endorsement that said this is what we're insuring. Most of the policies go back to your governing documents and say we will insure what you are required to insure. So the policy itself, a lot of times, it says a building, but building as defined by your covenants.
Okay. And one of the things you touched on earlier, could you go over that again about the recommending that your homeowners have a special assessment rider or whatever on their HO6 policy? Explain that again, if you don't mind.
Yeah, so I would recommend everyone that lives in a condo contact their agent and say, do I currently have special assessment coverage endorsement on my HO6? And if you do not, have them add a minimum of 5, but I'd probably say 10,000. I would say the cost is about $15 to $20 a year to have that endorsement added to your policy. And what that would provide is coverage for if a covered cause of loss, so fire, water, theft, tornado, whatever, and the association has a loss and then assesses you for the deductible, it would cover that deductible expense.
Okay. All right. So that's something that we can talk to the managers about and make sure that we talk about that maybe at annual meetings, just to make sure on condominium associations so they know what's going on. But it seems like an easy way for a little extra protection for the homeowners. Keith has one more question. Says, if you lose coverage because of a grill violation, does this force you to go to a secondary insurance?
It could. I would say in the past, not every insurance company inspected every community that we would write. So it is theoretically possible that one community insurance company cancels you. We go find another one. There's a question on the insurance application: are grills allowed on balconies? We always mark no, because legally under the fire code they're not allowed. So you could go to another carrier, and if they don't inspect, you could be insured. If they all inspected and saw them, yes, you would end up in the non-standard market, and even there they have exclusions. So in the non-standard market, the way they get around some of the underwriting is they basically write right into the policy, if this happens, like if you have aluminum wiring, we're not covering a fire.
Okay.
So that's another example.
Okay. There's 2 questions on here that kind of go together. One of them is, are there any tips you could provide on selection evaluation of insurance brokerage firm that will best serve our committee? But then also, we are a small HOA, single family homes, minimal fixed assets, and have a policy for things such as signage, fencing, no, and other small things, no clubhouse, pool, tennis courts. We do have a D&O written within their policy. And his question kind of goes with the other one up there. What is a good third-party source to review our coverage and make recommendations for revisions to consider?
So I think the first part of your question, if you were shopping agents, I would say people that are members of CAI, people that can really speak to the policy forms. So your agent should be able to literally take the policy form and show you the coverage differences. A third party that is not an insurance broker, salesperson, your HOA attorney, absolutely. And I know a lot of the CII ones, they recommend certain directors and officers policies over others.
Yeah, so what he's talking about is a lot of us use Eads Marine Pugh, Thrasher, Bushman, or KSN for different things. Those guys also are very good if you have some just more complicated questions that you think maybe Kirkpatrick can't answer. We do have a guy on staff, Joe Holland, who is kind of our insurance guy. He's very smart in insurance and has been doing this a long time, so he can maybe help a little bit. But if you want a third party, probably each of those firms can look over contracts. They're very good on that, and also they'll charge you a little bit for it. But sometimes that helps when you're facing the homeowners at an annual meeting. Say, hey, it's not just what Dan Quigley said, but we had Greg Chandler look at it. He's a stud. Here's David has a question. We currently have 24 PUD buildings, 48 units needing new roofs by 2030. We're raising assessments significantly each year. Oh, good job on that. And now our insurance has doubled this year, adding to the owner's expenses. Would the association be better off having homeowners pay all the insurance costs for the outside of the buildings?
I've gotten this question quite a few times in the last year. I basically would divide your annual premium by the unit count. And although it's way more than you probably paid in the past, I would bet it's still less than $1,500. And currently, I would say the average homeowner's policy, so where they would be insuring everything, I'd say the average homeowner's policy right now is $1,500 to $2,000 a year. So if you're trying to just compare whether you should do that, in most cases, if you're still with the standard market, I have found you're generally still under even $1,000 a year per unit. When you get to the non-standard market, it's probably close to a wash.
Okay. But a lot of times, in order to do what you're talking about, would require. I think Dave knows this, but would require a change of your documents, which is a whole nother round.
A massive.
We just had an association, Brackenwood with Delaware Trails. They did that, and they turned over. They were having trouble keeping up on the siding and roofing, and they turned over the outside of their building to their homeowners. It took them a while to get that passed, but it was something they all understood, and they felt like that way they could have more control over their homes. It was a PUD, but it was something that it worked out very well for them. And it was. I didn't think, I personally didn't think they'd have any chance to get that passed, but the homeowners, they wanted to take that over. They wanted to do that. So it just depends neighborhood to neighborhood a lot of times. And okay, another question. Yes, I think Paul can do this. If not, we can work on doing this at Kirkpatrick with him. Bill asks, can info be provided on specifics to share at an annual meeting about the HO6 so they can understand why this is and why to consider? I think so. We could maybe write up a little blurb for you or your homeowners, just to or your manager to read. It's just another coverage. It's another thing, like just you might never use it, but the people who do it, if something comes up, they're going to thank you for bringing it up. But you're never going to have everybody's going to be happy with you at these things. You guys are volunteers, that. But it's we can have something. We can do that, and we'll have it for the managers. Okay, I think that is it for questions and answers. I want to thank Paul for his help today. He's busy. As you know, if you've been out getting insurance these days, these guys are hopping. But I appreciate him coming through. I appreciate you all giving us your lunchtime, and we will see you again next time for board presidents and treasurers. Just a reminder, there is a May 9th roundtable that we're doing on financial information, financial reporting in the building here on the north side of Indianapolis. So there'll be more. You get more from that from Diane Arnett, who's our worthy messenger, and gets all this stuff out to you guys. So have a great day. Enjoy your spring, and we'll talk to you again next time. Thank you.